Hey everybody, Kyle, not your average finance guy, coming at you here with a little thing that when I first figured this out was mind blowing. I couldn't believe how much interest that a regular mortgage or anything, any loan that you're paying on, if you're just making the payments that the bank says to make, how much money they get up front in interest and how little you pay towards that loan. So I got a little example here that I want to go through with everyone and kind of show you how this works. It's I did a little cruising on the internet today and I found the average home price and the average down payment, the average, everything's average. Like just like me, your average finance guy. So here let's get to this here and jump in here. So time is money. The faster you can pay back the debt, the less you'll pay back in interest. So you want to try to jump on this as fast as you can. So here's my dad always said an assumption makes an ass out of you and me. So here you go. Here's our assumptions. We got a new house that we're looking at buying. It's $410,000 is the asking price. That's what we got figured out. We're gonna put 10% down or 41,000, leaves 369,000 for a loan at 6.4% interest. This is a new loan, current rates for 360 months or 30 years. So that comes out to a $2,308.12 payment every month. So everyone usually, okay, you get a nice house, that's what it is. So you pay that for the next 30 years. But do we really? No one lives there for 30 years. So, and the banks know that. So what they're going to do is they're going to get your interest. Most of that payment up front is going to be interest that they get to keep. And then what happens in 5 to 7 years when you either move or refinance because the value of your house went up, you can do a cash out refi. You can lower your payments. You can do all this other stuff. All you do is you start the cycle back over again. So here's the breakdown. Just like we said here. Okay, 410,000 purchase price, 10% down, $369,000 loan, 2308 times 360 payments. So if let's say that you actually live here for 30 years, which whatever, you probably won't, but let's just pretend that we see this all the way out. You make the payments, 360 payments on the first of the month for the next 30 years. You will have paid $830,000, almost $831,000 total for that house that was 410 that you had a loan $370,000. You're paying $830,000. That's $461, almost $462,000 that the bank gets to keep in interest over that loan period, over those 30 years. Okay, so yeah, me and Dwight, we're pissed about that, right? So look at the first payment. Your first payment of 2308, only $340 goes towards knocking that loan down. $1,000, almost $2,000 is interest. So that interest is gone forever. The bank just keeps it. And instead of owing, 369,000, you owe 368,660. Okay, so you still owe just about everything. It's basically an interest-only loan anyway. Look at all that interest that goes away. That's the first payment. The first payment is the worst. Every payment, you're going to pay a little bit more towards your principal and a little less in interest. But look at your first year here. First year of the loan, you're going to pay $27,000 in total payments. Interest that has gone forever is $23,000. Of the $27,600 you pay, $23,000 is gone. And at the end of the year, a whole year of making $2,300 payments, paying $27,000 the entire year, you got $4,200 that you've knocked that loan principal down by. That's disgusting, right? So let's not do that, right? Let's okay. Get my face out of the way. What can we do? Well, I'm glad you asked. Pay extra towards the principal and your loan balance is how we ultimately knock the interest down. The faster you can pay it off is the less in interest that you'll pay, and the more you can put up front, the more the quicker you'll compress this time. So if you've got any extra cash flow, anything you can do to get onto this loan up front will knock years off or time off of the loan, and then saving you payments, saving you extra money. All right. So the more you pay, like I said, the more you pay earlier, the more you save. All right. Sounds good, but how do we do that? Right. One of the easiest ways, a lot of people are paid biweekly. Some people are paid weekly. If you're paid weekly, that's even better. But let's just go with the bi-weekly example. If you're paid bi-weekly and your mortgage, is what was it? It's twice this, $2,300 or something. If you're paid bi-weekly, what you can do is each paycheck you get, pay half your mortgage out of each check, right? So you pay half your mortgage every time you get a check. Bi-weekly, you're actually going to make up 2 extra payments every year if you do that. So only doing that, it's pretty simple. Money comes in, money goes right back out. You make that extra payments. You'll have $104,000 in savings, and you'll shorten the loan by 45 months just by doing that one simple little trick. So what that does is it gets more money onto that principal earlier on in the life of that loan. Okay, extra payments. What else can you do? You can if you're paid bi-weekly, if you're paid weekly, pay a quarter of your payment every week, and that'll actually get you to the same. It'll get you some extra payments as well. So anytime you get your if you get a tax return back, if you get a windfall of money, if you want, try to maybe take a little bit and go on your vacation, but instead of going and blowing it all, let's put a little bit towards one of the debts that we want to do. Maybe it's not your house, maybe it's your car, your truck, whatever. But whatever debt you're trying to do, let's try to tackle that. But I just use the house as a good example here. This works for any amortized loan. All right. If you get a bonus of any kind, I don't know, maybe you get a safety bonus, maybe you get a yearly, performance bonus. If there's any kind of bonus or raise, what I like to do, what I heard a long time ago is whatever your raise is, take half of your raise and just use that as your raise. Take the other half and park it. Okay, either put it into savings or put it against a loan like this. Imagine every time you got a raise, hopefully it's yearly, you get a little bit of a raise, a little bit of a bump. Take half of whatever that is and put it towards your debt or towards savings or towards building wealth, and the other half you just use. What you're probably used to doing, just like I was, you get a raise and you don't know where it went. You just blow it, right? It's gone. By the end of the month, it's just gone. It was nice the first month you got it, but then 2-3 months in, you're just used to it and it's gone like everything else. Any windfall that you get, I don't know, maybe you win a couple bucks in the lottery, or you bet football, or hopefully you're not doing a lot of that stuff and losing a lot of money. I don't suggest doing that. I lost too much when I was young, so I stay away from that stuff. But any windfall of money, try to plunk it down towards that loan. Maybe you got a side hustle. I was just looking on Pinterest the other day, and my kid always likes to build stuff. So there's all kinds of decorations on there that you can build, and then he can sell those. And I just let him give all the money. We usually donate the money to something. But there's, if you got any kind of basic skills, you can make some of those stupid decorations and see what they're selling for on Etsy and stuff like that. Even just on, put them on Marketplace on Facebook, you can bring in a couple bucks for it. So any way you can just kind of crack at this and get that knocked down, the quicker the better. So this is a spreadsheet that I found, I don't know, years ago, and I'll put a link in the comments for this. You guys can grab onto this. But what I did is, this is just a picture of it here, but I'll get it live here in a second. I put the loan values in. So remember our loan, we put 10,000 or 10% down, and the loan value on this was 369,000. I plugged in the 6.4 loan period in years, number of payments per year. Obviously, there's 12 months, so I'm making 12 every year. And then the start date of the loan, I just threw this out as January 1st of 25, just to make it easy date starting at the first of the year. And then over here, it will spit out, the 2308, it spits out your payment. And then the scheduled number of payments, you're going to have 360. The actual number is 360 at this point because we haven't messed with it. But you'll see this cell right here is extra payment. And when we jump in, you can see if you start to put extra money into here, how fast this will go down. Your actual number of payments will go down, and you'll see your early payments and your total interest will usually go down too. Will always go down if you're making extra payments towards that. So let's see. Let me bring that over here and let's jump into that. All right. So with this one, we got all our numbers in here. Get this over here. Okay, So let's say we get this house and we get a tax return. Let's say by the time we get it in May sometime, whatever. We'll throw it in June 1st. We're gonna throw our tax return. Say we got $10,000 that we can put in. So I just enter $10,000 into that cell, push enter, and just like that, you can see up here that our actual number of payments went from 360 down to 334. All right, our total interest is 410,567. What was it before? It was 461. Okay, so by putting $10,000 in at the very front end of this loan, it saves you over $50,000 over the life of the loan. Okay, so that's one chunk that we did early. Let's say maybe you get when do you get your bonus? Maybe you get a bonus in, hopefully you're getting it, well, whatever. Let's put September, you get I don't know what's your bonus, $5,000 bonus. If you can get a $5,000 bonus and put that in there, look what it does. Okay, we've made $15,000 of early payments, and we've already knocked this down to $388. This is all within the first year. We paid an extra $15,000. Let's say nothing happens until, again, the next year in June. Let's say we get another tax return. Let's say it wasn't as good a year. We only get $7,500 back, and we'll put that in there. And let's say we got a raise. All right, so we got a raise, and we're gonna say we got a $50 small raise, $50 a month raise, and we're gonna spend half of it. We're only gonna put $25 every month in after that. So right here, I'm gonna put in 25, and we're gonna do $25 every single month. All right, let's say we just do that. And what you do on Excel here is you can grab this little corner and you can drag it down. And let's say we're going to do that until 7 of 27. All right, so, and then all I do is scroll back to the top. Now, at this point, we made an extra $22,000 of payments. We've already dropped 54 total payments off of this bill, and we're down to 358 in total interest. Okay, let's say you use Velocity Banking and you pay off your truck, and you've got you pay off your credit cards, you pay everything off, and now you're ready to attack this mortgage. Okay, and you've got, let's say you got $2,000 of free cash flow. So let's throw. We still got our 25. We're going to say 2025. We're going to make $2,000. $2,025 of extra payments every month, and we're going to do this for a whole year as well. So let's throw that into there, and by doing that, should be about another 24,000 we put in. Now we've made 47,000 early payments. Our total interest is down under 300 now. Remember, it was 460, almost 462,000 was our first one, and what are we? And we started this in 25, and now we are down to 28. So we're 4 years into it, and we've already saved. Let's see, 460 minus, call that 300. I mean, 100. That's over $170,000 right there. Okay, so look how quick this goes by getting these payments, and you can see it. I know there's a lot going on here with these spreadsheets, but here's your scheduled payment, and here's the beginning balance. All right, if you look down, the beginning balance there is $332,000. But here's the big thing: look at your principal payments. Okay, my first principal payment was $340. Interest $2,000. That sucks. Come down here after we've made all these payments. Look how much of a jump we've made. Now our principal, is that our principal payment? Yeah. Our principal payment is $2,700, and our interest payment is $1,600. So those have completely, or no, that was after we paid $2,000. So here's the regular swap is $700, and we're still paying $1,600 to interest, but we've drastically sped that up. Okay, by making all these extra payments, it's knocked the principal down. How much we owe right here is getting knocked down. So let's just keep on going. Let's say we get another small raise. Let's bring this up to 2,050. So 2,050, And let's do that. Remember, now I'm not even putting my tax returns in here. So you use those for vacation, whatever. I don't know. You're just putting your extra cash flow. If you really want to get after it, you can map this out. And I'll tell you, you're gonna map this out, and this is not gonna be right. Somewhere in here, you're gonna need new brakes and new tires, and something's gonna crack at that cash flow. So let's just say, okay, let's take 3 months off. 3 months without doing anything because we had setbacks. We had to fix the car. We had something else going on. And then, here in December, we can get back to it. All right. And this isn't even extra. We're just going to go and do the same thing we've been doing. Let's run this down. Let's go about another year. And let's say right there we just stop. All right, I'm done. I need the $2,000. I'm buying. I need another truck. I gotta do other things. Whatever you need it for. What if you just stopped? Right here, we went from 360 payments down to 209 payments. All right, so what's that? 150 payments less that we don't have to make. 150, and look how much interest. Now you're still paying. Yeah, you're paying $209,000 in interest, but that's a far cry from the 461 that you were paying, right? So I know it sucks. I'd rather use the $2,000 to go out to the bar or whatever, party and do whatever you want. But if you really want to get serious about this, the earlier that you put this money in towards the principal, the faster it's going to get paid off. So let's say, okay, how much did we pay? We paid a total of early payments. I'm just going to say we're going to make this up to, call that $100,000. So I got to put, what's that, $1,700 more dollars in. All right. So let's say we paid this, and okay, I'm off by 75, big deal. All right, $100,000 of early payments. Now what I'm going to do is I'm going to take this back to 0. I'm going to copy this back down. I'm just going to undo everything that we did, get us back to the baseline. All right, here we go, back to baseline. Run up, we're 461 in total interest paid, 360, nothing early. Okay, let's say we wait 15 years and then we get $100,000. We get $100,000 of inheritance. We don't do anything to the principal, no extra payments. We don't do anything for 15 years. Let's see, what's 10 years is 120. So here's the 10-year mark. And then, let's see, 180 would be 15 years. So let's set 180 right here. Bang, we're going to put $100,000 in. Okay? Let's say, well, let me even go a little bit bigger. $110,000. All right? So, big chunk, right? Big chunk, 15 years into it. What'd that do to us total? We'll scroll back to the top. And that knocked our interest down to 351. Now remember where it was when we started early and started knocking that down. We only paid $100,000 what we paid on it early. We had that thing down to about $200,000. So you're still paying $150,000 more. So the more you can get in towards this loan, the earlier, the faster you're going to pay this off. So the velocity banking can help with this, and the faster you pay this off, the more equity that you're then going to have. So even though you do come down here, let's look at, where are we? 15 years down, it was 180. Okay, look at that. The month before, we paid $876 towards our principal, and $1,400 still went to interest. Still, just, that's money out the window. Okay, it's gone forever. The bank is to keep it. That's why the banks are all these beautiful big buildings, and that's why they're so nice and friendly when you walk in the front door. And I heard that's also why they always have dumb suckers in there too. It's like, here you go, dumb. Have another sucker and keep paying me all your money. All right. So I guess the moral of the story is try to get this money in as early as possible. Let's zero this back out, and you can have this spreadsheet and just play around with it. I go on this extra payment cell is all I really touch after I put the initial stuff in here. But let's just say that you can do, let's say we don't put any of our windfalls, anything else. We're just going to we got to the point where we can cash flow $2,000. We've got all of our other stuff knocked out. So $2,000. And how long of making an extra $2,000 just putting our cash flow in every month can we knock this out? So let's go down here. Let's see, 60 months. That's 5 years. So in 5 years, we've got that down to 166,000, and we made an extra 120,000 towards principal. All right, let's keep going. Drag that down to, we'll go down to 120. That's 10 years worth. Oh, look at there. We are zeroed. We didn't need to pay it. We paid this off in 115 payments. Less than 10 years. By putting your free cash flow of $2,000 towards a $369,000 loan that was supposed to go for 30 years and you were supposed to pay $462,000. You now have it paid off in 115 months, and your total interest is $125,000 instead of the $461,000. And imagine what you would do in 10 years. You no longer have a house payment. You had $2,000 of extra cash flow plus a house payment of $2,308. All right, so there's $4,300 of extra money you have now. You have nothing to pay, no debts. What would your life look like if you didn't have that? It'd be pretty different, wouldn't it? So that's just a way to. All loans are like this. It's more drastic on these bigger loans, but if you got a smaller credit card loan, especially those that you're paying 20% on, I mean, knock those out quick. Those things are just terrible. Like I say in my other videos, I wouldn't always go after my home loan. Now that, if you're buying a new house and the rates are a little bit higher, but if you own your house before, during COVID and you got one of those stupid low rates in the 2s, 3s, 4s, I might think about holding on to it. But I also understand too, if you want to get out of debt, here's how you do it, man. I love this stuff. Thanks everybody. I'm trying to get a website going here, so notyouraveragefinanceguy.com. I'm going to try to put all the resources on there that you can just go grab and go check stuff out. Hopefully I'm helping you guys out, get yourself out of debt, and we're going to show you how to grow your money. All right, appreciate it, everybody.